My name is Daniel Whiting and I work for Holborn Assets. Now, Holborn Assets are the largest offshore wealth manager with around 250 advisors spread across Asia, Middle East, Africa, and Europe. And we're full, holistic, independent financial advisors. What do I mean by that? It means we do absolutely everything from healthcare, life assurance, through to wealth management, regular savings, and even second citizenship by investment. So we do things like the Portuguese Golden Visa. My email is below, firstname.lastname@holbornassets.com. And today's webinar is about how you can use your UK money purchase private pension for Asian retirement visas. Now, I'm going to focus the numbers today on Thailand because I'm actually based here in Bangkok. I'm in Bangkok at the moment. But if you decide you actually want to live in Vietnam or Laos or Cambodia or Philippines, etc., then obviously it's exactly the same process. I can still help you under the license I have here, but it's just the numbers are different. So I'm just going to be focusing on the numbers of how you can use your pension to get one of the many Thai retirement visas. And it's just how you meet the financial requirements for those visas. So just in terms of the aims of this presentation is, for some of you might be expats already here, in which case it's maintaining your expat lifestyle. For some of you, it's people who are going to plan to retire here and move here permanently in the future. And the reason why this is so topical and so relevant is that the Thai authorities have had a massive crackdown on these visa applications. What was happening is that there was a requirement that you had 800,000 Thai baht in a bank account to qualify for a one-year visa. And there were agents just putting 800,000 baht in an account for one day and then the 800,000 going out. It wasn't the client's money. Now, the Thai authorities have just massively clamped down on this. Bangkok Bank has closed or at the moment you can't use it properly for tens of thousands of users because of these fake bank accounts. And people are being told, and I actually sat with an elderly couple on Friday last week eating my fish and chips. And, they had just done the lump sum option. So that for them, £36,600 they'd put into a Thai bank account sitting dead. And the account value, to the horror, came out as zero. So they were knocking on the bank first thing next door. Why is the account zero? That's because you have to keep the money there for at least a couple of months. And you can't access it at all. And they said, when you go for renewal next year, you've got to have the money in there at least 2 months before and a couple of months after. So basically now, if you pick the lump sum option, you've pretty much got to have 18,300, depending on exchange rates, just sitting dead in a Thai bank account that you cannot access, earning virtually no interest. Because the interest rates here are just 1.5%. So there's no interest. And the question is there a better way? And the answer is yes. In that you can have all your capital and all your money working hard for you by qualifying via the income option. And this just ensures that you have no money left dead in a Thai bank account. All your money is working for you. All your money is invested and growing and available for your beneficiaries. So the aim of this presentation is to show how you can qualify for these retirement visas using your pension income. Now, this might be the whole of the solution for some of you, and it might be part of the solution for some of you. Now, if you've got rental income or passive income from ISAs and PEPs, etc., that also can be part of the solution. But I'm going to talk about just the pension solution, and I'm going to be focusing on what's called phased flexi-access drawdown. Now, some of you may have heard of flexi-access drawdown before. I'd be very surprised if any of you heard of phased flexi-access drawdown before. Now, this is not something new. This is very old. I was doing dozens and dozens, if not hundreds of these back in the early 2000s when Equitable Life went bust. But it's just gone out of fashion for advisors to use it in the UK since the introduction of platforms. But actually, phased flexi-access drawdown is the best way to use your pension to get the most tax-efficient income and requirement, and gives you total flexibility and control over the level of income and what you can pass to your beneficiaries. And this is what I'm going to do as a pension advisor with my own pension pot. But it's important to understand that everybody's circumstances are different. So it's very important to seek advice because this is a very complex area. So just in terms of my qualifications and experience, so I actually joined the industry back in 1997. So I've been around. What's the benefit for that for you? Well, apart from the 87 crash, I've been around for every single major stock market crash since 2000, when the first tech bubble hit. And then since then, 2008, global financial crisis, 2012, COVID, Ukraine war, been there, done that, and seen all the mistakes that were made and so know what to do and to say to clients. And I've advised in the UK, which is ludicrously regulated by the Financial Conduct Authority. I mean, to give you an idea, if you want to take £10,000 out of your pension fund to do up your bathroom, your advisor has to write you a report because you do get hit by the emergency tax rate. So, that's how crazy it is in the UK. But what's the benefit for you as the client of dealing with someone with qualifications and 27 years experience in the industry? Let me just give you a couple of examples. Now, there's an advert going around on Facebook saying you could potentially suffer 45% income tax on your pension in retirement. Now, if you'd done the G10 taxation and trust exams I have done, you actually have to do a self-assessment tax calculation during the exam, and you understand UK taxation. And if you do understand UK taxation, you know that you don't pay 45% income tax until your income in retirement is in excess of £125,140. So there's only a minuscule amount of people who have that as a pension in retirement. Most people don't ever earn that income in their life, and most people don't even get to 50% of their working income as an income in retirement. But added to that, this sort of advert says, you could suffer 45% on your pension income. Now again, if you've done G60, understand final salary schemes, and you've been in the pensions industry for the last 20 years, then you would know in the UK there's been a lifetime allowance, which has stopped people building huge pension pots. So if you start into ChatGPT, how many people have got, over £1 million in their pension pot, it's only 2% of the population. Now, to have an income of £125,140 as an income in retirement, you would need about £2.4 million in your pension pot before you even started to pay tax at that level. Now, the amount of people that have got 2.4 million in their pension pot is much less than 1% of the population. So to have an advert that says you might suffer 45% tax is just scaremongering. And if you've done the exams and you've got the experience, it's just scaremongering. Just to give you another couple of examples of the benefits of working with someone with qualifications and experience. So I have an investment exam. Coming over here, there are advisors who, work for Aldi for 23 years, they become an advisor, and then suddenly they turn into stockbrokers and they're advising clients to buy a 3 times geared NVIDIA ETF. I'm very much a Warren Buffett kind of guy. And by that, I mean, I work within my circle of competence. So I worked for an asset manager for 20 years in a life and pensions company. And every single month, we go and have sales meetings in other asset management houses, who we work with, so BlackRock, Schroders, M&G, etc. And you're not just meeting the sales reps, you're actually meeting the economists, you're actually meeting the fund managers like Alistair Munday, who at the time was famous in the Investec Cautious Managed Fund. So in terms of who you're picking to work with to meet these financial requirements, I just think it's better to work with someone who's actually got the exams and the experience in the City of London than someone who's just watched a few YouTube videos. And finally, just one last thing on the qualifications is this. There's an exam called AF5. It's actually the hardest CII exam to pass. And the reason why it's the hardest is because you get a case study 2 weeks before the exam, and then you get a 3-hour written exam asking questions and to put a plan together. Now, the reason why I say this is because there's so many adverts offering a 1-year fixed rate. Can I just say, a 1-year fixed rate is not a financial plan. It's not. And if you've advised in the UK and you do the job properly, and you put that down the AF5 exam, you get 0 points. A financial plan is understanding a client's financial goals, understanding where they want to get to, understanding their financial situation now, and putting a plan in place to achieve that goal. That's doing the job properly. So for the sake of this webinar, the financial goal is to meet the financial requirements for one of these 2 Thai retirement visas. Now, what I would stress is that I don't actually do the visas. So I work with professional introducers, and these are the people that you need to speak to first, because there are many types of visas, and your circumstances, whether you're married to a Thai partner, whether you have a child here, or whether you want to make a lump sum investment into a condo, the type of visa that you actually want that suits you, you need to have discussion with that professional introducer first. What I can do after is just help you meet the financial requirements. And I'm just going to go through 2 of the main visas that are available. So the most popular one, because it is the cheapest one, is the Non-Immigrant O or OA visa, which is renewed each year. And this is the one that's had the biggest impact because people were putting in 800,000 baht and then taking out the next day. That is now over. So either you've got to keep that money in that account permanently and it's dead money you can't access, or you can qualify via the income option. Now, the income option is 65,000 baht per month, which is about 18,000 pounds per annum, depending on the exchange rates. So I'm going to show you how you can achieve that figure with your pension fund. The other key visa is called the long-term retirement visa, which is valid for 10 years. The difference between the two is the amounts of money that you need to qualify for these visas. So for the 10-year visa, you need to either put 3 million Thai baht in a bank account or have an income. It always says, on the website, $80,000. It's around, depending on exchange rates, 58,000 per annum. Now, depending on your circumstances, whether you've got, a state pension already coming in, you've got rental income, you've got PEP and ISA income, but you're going to need a pension fund of 700,000 to $1 million plus in order to qualify for that LTR long-term visa. But I'm just going to show you, it's the same process, it's just the amounts are different. So how can I help? Well, how I can help is to give you a strategy to maximize your net income. What do I mean by net income? Net income is just after taxation. So if you follow this process, you'll meet the financial criteria for one of those 2 visas. You'll then have complete control and flexibility over your income and your investments. And also you'll have wealth preservation. So you'll have money to pass to your loved ones, your beneficiaries, your children, your grandchildren. You have money left rather than buying an annuity. Now, on my compliance department, they've said I must put in this disclaimer that I cannot transfer guaranteed benefits over 30,000. Again, this would only be if we had a one-to-one conversation that this would even come up. So When you leave the UK, you basically have two options. If you've got a pension scheme coming to you from Aviva or Scottish Widows or Aegon, is you can say, right, I live in Thailand and I want my pension sent to me gross and I'm going to pay Thai taxes. Or you can opt for the UK to remain first taxing rights. And actually, to keep the UK, the HMRC, as having first taxing rights is actually hugely beneficial. Now, the reason for that is because of the personal allowance. Is that the first £12,570 of income that you receive from your pension is tax-free. And you also get 25% of your pension pot tax-free. It's now called Pension Commencement Lump Sum, or PCLS. And there's a double taxation agreement with Thailand, which means you don't get taxed twice. But it is also crucial to understand that pension income is treated differently than income from when you're working. So if you run a business or if you're employed, that's called earned income. Pension from your pension pot is called unearned income. It's categorized and treated differently. And it's important to understand that difference later on in the presentation. But basically, you can use your pension pot to meet the requirements for the retirement visas. How can you do this? Well, you can do this by using Flexi Access Drawdown. Now, what a lot of people in the UK don't really appreciate is how lucky we are to have this. If you come from the Netherlands, then you have no choice. You have to buy an annuity with your pension fund when you come to retirement. Whereas in the UK, we have pension freedoms. You get to choose how much you take out of your pension fund, when you take it out, how much of your tax-free cash you use, etc. You can have up to 25%, but you don't have to take it all up front. But the final two are the most important when you're moving abroad, which is the income management and sustainability planning. The income management is that when you move overseas, you do have unexpected costs. So if you just come to retirement and buy an annuity, it just means you get a fixed level of income paid to you. It might go up by RPI, but generally it's just a fixed level of income. But there are unexpected costs. You might need to buy a car. You might need to pay for a hip operation. Health insurance costs get more and more expensive. So having that flexibility of the income management is hugely beneficial. And the reason why it's so important to work with an advisor is because of sustainability planning, which is basically making sure that you don't run out of money. Now, this is important because there are costs that go up the older you get, like health insurance, for example. So this is why I always encourage clients to transfer into an offshore SIP, just so that I can manage their affairs, manage their investments, and manage their income stream to make sure they've got complete control, get the income that they need, and to make sure they're on track to ensure that they don't run out of money. Now, what advisors in the UK have traditionally done is when a client reaches, say, 65, they get their statement from Aviva or Scottish Widows or Aegon, and it says you can buy an annuity in X, or you can have tax-free cash and a lower income of Y, or speak to an advisor about Flexi Access Drawdown. The advisor then says to the client, well, you can have 25% tax-free cash. The client says, yes, please, put it in my bank account. But the thing is that actually, while that money is in a pension pot, it has many advantages in that it's growing in a tax-free environment, it's actually invested, and under £1 million, well, 1,073,100 to be exact, anything below that figure of $1 million is inheritance tax-free. But if you don't need that tax-free cash and you put it in your bank account, it's now in a taxable environment, it's part of your estate, and you're earning virtually no interest on it. So is there a better way? Is there a better option? And the answer is yes, there is, and this can help you with your retirement visas. And the answer is phased Flexi Access Drawdown. So who is this really applicable for? But you can't actually take your pension until you reach age 55. Some people might have a protected retirement age of 50, but for the vast majority, it's 55. And in terms of the tax benefit, it works better if before your state pension kicks in, but it works just as well if you've got a state pension as well. Using phased flex access drawdown, you can meet the financial criteria for either the non-immigrant O and OA visa or the LTR long-term retirement visa. And the big points here is you don't need to hold any capital. It's just dead in a Thai bank account. It also gives you flexibility in that you may want to change your visa in the future. You may want to invest in Thailand to buy a condo, but you don't have to make that decision up front. You might want to move around a few places and decide, actually, I don't like Phuket, I want to move to Krabi. There's no remittance tax, 3 stars. I shall go into this because it's the elephant in the room. I shall go into this in detail. But phased flex access drawdown is the most tax efficient way to get income out of your pension fund. And I'll just demonstrate that very shortly. And whatever's left in your pension pot, you get to pass to your loved ones, whether they be in the UK or in Thailand. But it's important to understand that drawdown carries investment risks and sustainability risks. So personalized advice and working with an advisor like myself is absolutely essential. So now to the nitty-gritty, and to give you an example. Now in bold is the goal. To meet the criteria for the non-immigrant O, which is the most popular, you need to demonstrate 65,000 baht per month, which based on current exchange rate is around 18,000 per annum. So I'm just using the example where all of this 18,000 comes from your pension pot, in which case you need about 360,000 in an uncrystallized pot. Now, some of you thinking, I don't have that amount of money in my pension pot. Everybody's circumstances are different. So if you're already receiving a state pension, well, that's 12,000 or 18,000 already covered. If you're below that age, if you've got £8,000 coming in from a rental income from the UK, and you've been working as an expat, and you've got £3,000 coming in from an offshore regular savings plan I set up, and you've got perhaps an ISA income of about £2,000, it might mean that actually what you need from your pension fund to complete the pot is only 5,000 you need from your pension, in which case 80 or 100 grand pension pot is going to get you to where you need to get to. But I'm just using 360 as the example because it's just the perfect example of how to use a pension. So in this example, the way that Flexi Access drawdown works, phased flex, is you take a mini drawdown. So instead of moving the whole pot into Flexi Access drawdown, you do a mini drawdown. You just transfer 21,720 into a drawdown plan. You take out your 5,430, 25% of that as tax-free cash, which is pension lump sum. Here's the great bit. The taxable income that you take is 12,570. The reason why that's so good is because your taxable income is below the UK personal allowance, it basically means that you can get £18,000 each year out of your pension tax-free. And you still have the balance uncrystallized. So it's still growing in value. The tax-free cash is still growing. And if all those numbers seem so bit difficult to sort of comprehend, I've got the exact same numbers, but just as a diagram. So you've got your pension fund in the right. You did have 360 in it. You just take a small portion of that, 21,720, and you move that into a mini drawdown. The shaded blue area is your tax-free cash, and your taxable income is taken on a monthly basis. So, as a benefit, you get £18,000 per annum tax-free. Now, you do have to repeat this process each year, and eventually it will become less tax efficient after year sort of 5 or 6, but that's how well this can work. And the other crucial point is the 338,000 uncrystallized pot is still growing in value. So if that then grows and is vested and it gets to, say, 350,000, and then you decide, actually, now I want to buy a condo, well, you've now got 25% tax-free cash of 350,000, which you could strip out in one go to pay for your condo. So this is why it's the most tax-efficient way of actually using your pension pot, going down the phased flexi income route, because of how much you can get in terms of your net income. Now, the big elephant in the room is Thai remittance tax. Now, I have to start with a caveat and say, please discuss with a local tax advisor. But before I'm preparing for this webinar, I spoke to Q8 partners who are international tax advisors and asked their opinion on this. And they went and researched the web and looked at what various different people were saying. So first thing, they looked at PwC, PricewaterhouseCoopers. This is one of the big four accountancy audit firms in the world. And their assessment is that Thai remittance tax is only assessable on income derived from employment or from business, from earned income. Now, as I stressed to you earlier, pension income is treated differently. Pension income is unearned income, has a different classification. So under this, any pension income you get from the UK is not assessable for Thai remittance tax. This is backed up on the Thai Embassy official website, is that only income earned inside Thailand shall be subject to tax during retirement. What does this mean? Let's just say you're getting your tax-free income from UK, you've been here 2 years, and then you're bored. You think, oh, I'm going to open a bar. If you open a bar in Thailand and that bar makes profits, then you're subject to Thai tax. But that's just on the money that you're making here in Thailand. It's not impacted. Your money from your pension pot is outside the remit, is not accessible for Thai remittance tax. There is a double taxation agreement in place. And this is why I stressed is why if you keep the UK with the first taxing rights, then there's no Thai remittance tax. It's being taxed. Now it's over here in Thailand. And also what's not accessible is the return of capital. So if you want to get really specific, your entire pension contribution history over the last 30 years is actually just return of capital. But I think the most compelling reason, I haven't even put it on the slide, is everyone sort of thinks of their own country. Everyone's sort of UK-centric. But just think of every nationality, whether it be American, Australian. Americans are the biggest population, about 200,000 over here in Thailand. And the second biggest is UK and then Australia. Now, the American 401k works exactly like the UK pension. You get tax relief on the way in, taxed as income on the way out. The Australian superannuation scheme works in reverse. You have to pay tax to get it into your pension scheme, but then the income you get in retirement is tax-free. Now, either no country's pension system works in Thailand and every nationality is due Thai remittance tax, in which case, don't buy a condo in Pattaya because it's going to be empty, or everyone's pension scheme from every country works as it should do, and if the host country retains the taxation rights, then there is no Thai remittance tax to pay. So that would be my take on it. That would be the take of, say, Q8 partners. But I have to caveat, please speak to a local tax advisor. So what does phase flexi drawdown give you? It's the best way to get the highest net income in retirement. Now, in this example, I've said the target, the financial goal, was to achieve one of the two Thai retirement visas. So either 65,000 baht per month, or for the LTR visa, it's sort of £58,000 per annum. In which case, as I say, you might need a 800,000 to £1 million pot. but it's whatever level of income you need. If you decide you need £30,000 per annum, then the most tax efficient way of achieving that is through phased drawdown, because it's the combination of tax-free cash and taxable income. Now, eventually you will run out of tax-free cash, so this doesn't last forever. And that's why it's important to have ongoing advice so you understand this and the sustainability. But that's why phased flexi access drawdown is so tax efficient, because it's unearned income. There shouldn't be any remittance tax, but you do have to repeat the process each year. So it's not an automatic process, which is again why you need to deal with an advisor to not only invest your money and manage it and understand the difference between accumulation and decumulation, but also just to manage that transfer every single year. And as I say, whatever's left is passed to your beneficiaries. So to put it very simply, the benefits of phased flexi access drawdown are no UK tax, no remittance tax, and currently no inheritance tax. 3 stars. Now, this could be a webinar in its own right. So as the rules stand today, if your pension pot is under 1,073,100, then there is no inheritance tax to pay on your pension pot. What Rachel Reeves, the world's most popular chancellor, has suggested that in 2027, she's going to reduce that figure from 1 million down to 0, so that every single penny is counted in your estate for inheritance tax purposes. Now, this is going to be an extremely unpopular policy, especially for the large number of MPs in London and the South, because house prices in the South take people over the nil rate band of 325. So when you're giving advice, you should always just give advice on what are the rules today. So the rules today are, in this example, if you had 360,000, that would be free of inheritance tax. Anything under that 1,073,100, free of inheritance tax. It may change in 2027. If it does, there's an election in 2029, and I'm pretty sure that the Conservative Party would have this as a central policy to win back Middle England. So, but if I'm giving advice today, I'm using it on the rules of today. Now, it's very important to offer a balanced view and to make sure you understand the risks of going into flexi access drawdown. So the first big risk is mortality drag. Mortality drag is just basically the difference between buying an annuity or going into drawdown. Now, there are 2 impacts of mortality drag. The first, both of them are really called mortality profits. What does this mean? If you turn 65 and you buy an annuity, you're pooled with hundreds of thousands of other people who are also turning age 65. And when the actuaries are pricing it and they're looking at hundreds of thousands of people, they know that some of them are going to be dead within 18 months and some might live for another 18 years. But they can give a higher price on the annuity because they've got such a large number of people and they know that they make money on the people who don't actually live that much longer. So if you don't buy an annuity, you're going to draw down, you miss out on those mortality profits. The second impact of mortality drag is the longer you live, the longer you are expecting to live. So if you didn't take an annuity at 65, made it all the way through to 75, and then decided, right, now I want to buy an annuity, then the way the actuaries would look at it is they'd think, well, because you made it at 75, we think there's a pretty good chance you're actually going to make it to 85. So that the annuity rate that they would offer you is again made worse, and you're missing out on mortality profits. So those are the 2 mortality drag risks which have to be in the report. The biggest concern when you go into drawdown is the sequence of returns. Could your money run out? Now this, I'm going to give some numbers and I may need to follow up an email afterwards, but I'm just going to try and make this as simple as possible. What happens in the first few years of drawdown is vitally important to whether or not you'll run out of money. And I'm going to give this simple example. Let's just say you start with £100,000 on your pot. You want to take 5% income. Your fund value is now 95,000. And let's just say there's a downturn in the investment market and bond market, and your fund value falls by another £5,000. So you've now got £90,000 in your pot. In year 2, you still want £5,000 per annum as an income. But now £5,000 as a percentage of £90,000 is no longer 5%. It's 5.5%. So unless your pension pot grows by at least 5.5%, then your pension pot is going to continue to go down each year. So that is why it's so important to work with an advisor that understands risk, understands the difference between accumulation and decumulation, and can put in place an investment strategy to try and mitigate that risk. Also, one of the key factors is investment diversification. Now, the biggest mistake I've seen in my 27 years in this industry is people who put all their eggs in one basket and always property. So many people have been hit by this over the years. Going back, to 2006, is they put 100% of their drawdown plan into, say, the Brandau Student Accommodation Fund, thinking, it's got an amazing 12% yield. The fund collapses, you're in drawdown. Not only can you not access your capital, but you can't actually access any of your income. So you're completely stuffed. There's a simple solution. It's the basics of investment diversification. Just build a diversified portfolio of different asset classes and different geographical areas. You could still suffer investment loss, but you're just spreading your risk. And then part of that is just having ongoing support and service. And having a strategy is vital. And that's why it's so important to work with an advisor if you go down the drawdown route. And just in terms of the wealth management side, so based on my experience, exams, and I could put a portfolio together with you based on your attitude to risk. Everything is bespoke. It should be a combination of active and passive. If you prefer, you can outsource the investment to a discretionary fund manager if you have enough funds. This will cost more money, but then you're with specialists who are just creating income portfolios, and they're doing that all day, every day. But the most important thing, and with either option you go for, is that you have a strategy and you understand the difference between accumulation and decumulation. And you have a global approach. So you're looking at different asset classes, not have everything all in the US, have it spread geographically all over the world in different asset classes, and then you mitigate many of these risks and actually get a positive return and the income that you need. What's the end result? End result, and the most important thing for retirement, and the whole point of it, is peace of mind. If you go down this route, you'll hopefully have an enjoyable retirement, because you know that every single year you're going to be able to meet the requirements for whichever visa you opted for, whether it's the LTR or NIO or OA option. So you're going to get the most tax efficient income, you've got a lump sum to pass to your beneficiaries, and there should be no remittance tax. So just to summarize and to finalize, the benefits of Flexi Access Drawdown are huge, which is why I'm going to use it myself when I get to retirement age, is you get to choose how much you take out of your pension pot and how you flexibly access your pension pot. And that's just perfect for the expat lifestyle and the changes that you constantly get and the capital and income needs that you might have. You get to choose what income you take, You can increase it, decrease it. You can take out lumps of capital if you need it for specific circumstances, like, I say, buying a car, or you've got your annual health insurance bill that you need to pay. You can dip into your pension plan. And what it gives you is just control of how much you withdraw each year. And you're just maximizing the tax alpha. And this is just compared to sticking £18,300 per annum into just for 1 year, into a Thai bank account, and then that being blocked and you can't access it. This is a much better solution because all your capital is working for you, all your capital is working hard, and you're getting the most tax efficient outcome. But it is important to stress there are risks involved. I would go through those individually if you decide to work with me, and that drawdown values and tax outcomes does depend on market performance and individual circumstances. But the only way to find that out is to work individually. So I'm just going to leave out the disclaimer there for you to read through. What I see for this is there's probably 3 categories of people that this whole presentation may be worth for, which is there's people already here who have just got the money sitting in the bank. Next time you come up to renew your visa, maybe have a conversation about the income option. There's people who are at retirement who are making that decision now. Hopefully you can see the benefits of going down this route. There might also be people on this call who are younger, and you've seen the figures, what you need to get to, around 360,000 to give you that income. If you don't have that now, then start planning now. So if there are younger people on the call, then obviously I can help with regular savings or lump sum investments and help people get to the point where they know that when they want to retire, they've got enough funds to meet the financial criteria for the retirement visas. So I hope all that makes sense. Thank you very much for listening. I'm now going to stop sharing and just look at the questions that are in the chat box, in the Q&A. Okay, so a couple of questions. Firstly, is just on the Thai remittance tax. Thailand keeps changing its mind every 5 seconds on taxes. And there's just been a change of the Prime Minister. There's constant change here all the time. There's also a massive difference between the laws and the application of the laws here in Thailand. So as I went through the presentation, I think the biggest thing to take away from that is don't just think UK, think every nationality, especially the American market, because that's the largest, 200,000, their pension scheme works exactly the same as ours does. So if we have to pay, as a UK person, Thai remittance tax, so do they. It either impacts all of us or none of us. I've taken tax advice. I just don't think that there is any Thai remittance tax, but speak to a relevant advisor. Another question is, you say that the pension pot below the LTA is not subject to IHT. Will that change in 2027? Yes, hopefully I went through that in the presentation to say that Rachel Reeves has said this is her plan changes. I just don't think she really appreciates how big a hit this will be and how unpopular this will be because of house prices and where you live. You know, people living in the south of the country, and especially there's so many London Labour MPs, because of the house prices in London, a lot of people are over that threshold of 325,000. So that means their pension pot is going to get dragged into, and they're going to have to start paying 40% inheritance tax. So I just don't think she'll actually go ahead with it. You know, it's just a suggestion. I think even if she did go ahead with it, then I think she'd quickly either change her mind or, you know, the Conservatives would come in and say, we're going to change this, and it'd be a landslide win for them in 2029, which will be the next general election. Someone who's about their specific circumstances, so I will come back to that person about, they've said how much they've got in their pension pot and their age, and they've got per year. The answer is potentially, but please send me an email personally with that same question and I can respond to it. Just in terms of the qualifying criteria, it's just a case of, depends how long you've been in drawdown, or if you can show your bank statements for a couple of months, then that will demonstrate that you've got this income coming in. Depending on how you come into the country or whether you're here already, will also help in terms of answering that question. So some people come in on a 3-month tourist visa, take out this plan, they've got the money to demonstrate that they can qualify for the income requirements. And it's just about working with the advisors, the experts in this field. So as I said earlier, I don't actually do the visas. All I'm doing is helping people meet the financial requirements. So, in terms of actually getting that visa, it's best to speak to the actual experts who do the visas on a day-to-day basis. Hope that makes sense. But thank you all for listening today. Very much appreciated. If you've got any other questions, please drop them to me personally. I'm going to end the webinar for today, but thank you for listening. So you will get a follow-up email from me. The webinar will be available to watch again. And if you've got any questions, please drop me an email, daniel.whiting@holbornassets.com. Thanks for listening, and hopefully I'll be in contact with many of you very soon.